Everyone is chasing the shiny new thing in investing. What's the new super app going to be? Who's going to win the AI race? What company is going to be the next Netflix? These are questions that I hear very often, and all it takes is one look at online forums, and you'll see that these are some of the most common questions that people always ask. Everyone wants to know what the next Amazon's going to be, when the next Palantir is going to be. Part of that is some FOMO, fear of missing out, but mostly it's people just trying to get in front of a big trend. Don't get me wrong, being ahead of the curve is super exciting. It's like a never ending chase, and the rewards for being successful are extremely high. Just look at the returns that someone would have had investing in a stock like Netflix. These are life changing returns. And when you look at a chart like this, it's no wonder that people spend most of their time trying to find the next Netflix. If you play your cards right and if you get lucky, you can make a lot of money very quickly. But guess what? A lot of people end up losing their shirts trying to chase the next Netflix. While most people are out there trying to place their bets on what the next big thing is going to be, most people ignore the four companies that will win no matter what. Today, we'll be talking about a small group of four tech companies that are responsible for pretty much all the innovation that's happened in the tech sector over the past 30 years. Now, quick credit where it's due. I came across the idea for this video while listening to William DeGale on the Synopsis podcast. It really sharpened how I think about disruptors versus enablers, and I really recommend anyone who's serious about investing to listen to this podcast. Disruption, disruptors. We've all heard that description for a company. It's become a really common way to describe any type of company that's growing its sales at 20% a year and that is trading for a super high multiple. But for the sake of this video, let's just assume that a disruptor is any type of small startup that's taking on the incumbents, the big guys, and trying to just change the way an industry works, change the status quo of that market. Usually, they do this by having some sort of new technology that allows them to compete with the larger players. But here's the thing, most of these disruptors never make any money for their investors. And that sounds really counterintuitive because these disruptors are the ones changing the way the world works. They're the exciting new companies that are on paper making a lot of money to their early investors. But those are only the success stories, the ones we've all heard about. If you actually aggregate all of these disruptors into one basket and you look at the returns of that basket, you will notice that the basket never makes any money for its investors overall. There are three main reasons why this happens. The first is cost. First of all, it's very expensive to come up with a new technology. A lot has to be spent on talent acquisition. A lot has to be spent on research and development. A lot has to be spent on infrastructure. All this just to come up with a new piece of technology that will allow the disruptor to compete with the incumbents. As a result, a lot of the early money by the early investors is used up and spent on developing these new technologies. The second piece of the puzzle here is competition. By definition, a disruptor is an upstart, a very small company that's taking on the industry, taking on the big bad incumbents. These incumbents are a lot larger, they make a lot more money, they have a lot bigger of a balance sheet, and therefore they can spend a lot more. There's the whole game of strategy involved, and not only do the disruptors have to compete with the incumbents, but they have to compete with other disruptors because as soon as one founder has a good idea, a lot of imitators are going to start popping up. Everyone wants a piece of the market. And finally, you have to think about incentives. Think over the last decade to the rise of venture capital and all of the exciting new companies that venture capital has backed. They don't care if those companies are profitable or not. That is not the point. The point is for the company to grow its revenues very quickly, scale as quickly as possible, such that these companies can then be sold on to the next investor. It's about hype, it's about excitement, it's not about long term profitability. So, if a disruptor doesn't end up in bankruptcy within the first 5 years due to competition or all the costs that they have, usually it stays unprofitable for a very long time. Let me give you two examples from recent history. The first being Uber. Uber lost money for its investors and wasn't profitable for the first decade of its existence. It was only in the last year or two that they've become a profitable company and that management was able to turn things around. And Uber is a success story next to WeWork. WeWork is one of those companies that was never profitable and still isn't profitable. And I believe WeWork might have gone into bankruptcy last year if I'm not wrong. So instead of asking who is the next disruptor going to be, it would serve investors better to ask who is going to enable those disruptors, who is selling the picks and shovels during the gold rush. Because that's who's going to succeed whether or not the disruptor succeeds or fails. Let me give you an example. Back in the 1800s, railroads were the peak of technology. They disrupted canals, they disrupted road travel, they changed the world. They helped economies really boom and prosper. There was a massive hype around railroads, and deservedly so. That hype caused a rush of new railroad companies, and at the end of the day, most of these companies went bust. It's not a big surprise. It was due to overinvestment, brutal competition, and a lot of investors in railroad companies ended up losing their fortunes. So, who made money from all of this? Well, it was the people selling the coal, the iron, the steel. Those companies really made bank. Because it didn't matter which railroad was going to win at the end of the day, they were all going to need these materials. It's really the same story with airlines and air travel. Everyone loves to romanticize air travel and airlines. It's glamour, it's being able to travel very quickly from one place to the next. This is another industry that really changed the world. But if you look at the history of airlines as a business, it's brutal. Airlines are classic disruptors. They disrupted car companies, they disrupted railroad companies. They ended up having to fight each other over price wars, they overexpanded, they burned cash on new routes and shiny fleets, and then almost all of them went bankrupt at some point. Even Warren Buffett famously said that the airline industry has destroyed more capital than any other industry in history. So you have airlines that are a terrible business, but what about the companies that allow airlines to function properly? Well, those are some of the most successful businesses in history. You've got Boeing and Airbus, two companies that sell the planes to these airlines. You have GE and Rolls-Royce that sell the engines to the airlines. Then you have the airports, the fuel providers, and all the engineering firms that supply services and parts for safety. These companies succeed no matter which airline does the best. None of these companies are disrupting anything. They are enabling the disruptors, the airlines. And at the end of the day, these are the companies making money. We can talk about streaming, which is just the most recent example that I can think of. Netflix disrupted cable TV and invented a new over the top TV business model that was delivered straight to your house via the internet. Disney, which used to be one of the incumbents cable TV players, tried to defend its empire. The end result is that both companies ended up spending billions of dollars on technology, servers, and bandwidth. Netflix bled cash for a very, very long time, and even today, they spend enormous amounts on capital expenditures, all related to technology. For Disney, it's exactly the same story, just with a bigger balance sheet and more to lose. The end result is that over the past 5 years, both companies have spent an incredible amount of money on technology. The companies selling the chips that make that possible, the companies selling the cloud infrastructure to make that possible, they don't care who wins. All they do is collect checks from both companies. The truth is that every new big wave of disruption since the 1960s, whether that be telecom, internet, metaverse, AI, all of it runs on the same backbone of technology. There's a key group of companies that are responsible for selling the technology that's going to enable the disruption that will come from AI. And not just this wave of disruption, but the next and the next and the next. All of these waves of disruption depend on one technology: semiconductors. Any firm that has anything related to semiconductors, at the end of the day, they will be the ones supplying the incumbents and the disruptors, the winners and the losers, for wave after wave of disruption. Think of Nvidia for a second. They powered crypto, then they powered the metaverse, and now they're powering AI. That's 3 waves of disruption in a row. As an investor in Nvidia, you don't really have to care. You don't really have to know what's going to come next. Nvidia's chips are some of the most advanced piece of technology in the entire world. And as long as that stays that way, every new wave of disruption will have to use Nvidia's chips. If you like this kind of analysis, the Signal newsletter goes even deeper. It's free, it's bi-weekly, and it dives into some very important subjects related to business and investing. I'll leave the link in the description and the comment section of this video. And if you want Rated A's ratings and portfolio moves delivered straight to your inbox, it's only $19 a month. So far, we're doubling the S&P 500 this year. Now, back to the video. Nvidia certainly is an enabler, but even Nvidia has lots of competition. AMD is one. The Mac 7 is another. Remember, the Mac 7 is Nvidia's main client, and all of them are scrambling right now to find an alternative. If we follow this enabler mindset, who are the ultimate enablers? If you follow the food chain all the way down to see who is enabling even Nvidia, you'll see that the main platform holding everything down is a group of 4 or 5 companies globally. Now, William DeGale is a genius. He spent so much time in the tech industry, and he's come up with this really cool analogy that I love. He talks about a champagne pyramid. We've all seen it. There's many glasses on the bottom part, a few less glasses in the middle layers, and only one champagne glass all the way at the top. The waiter takes the bottle of champagne, pours the champagne into the top glass until it overflows, and little by little, all the glasses underneath get filled up. The tech industry is an inverted champagne pyramid, where the bottom layer only has one glass and the top layer is consisting of many different glasses. At the bottom, you have 4 companies, and they support the entire industry. That's ASML, Applied Materials, KLA, and Lam Research. The layer above is chip makers like TSMC, Samsung, and Intel. Above that, you have chip designers like NVIDIA, Marvell, and Broadcom. And all the way at the top is a layer of thousands of exciting disruptors. These are all the software AI companies that make the headlines in the news. It's a guarantee that any given year, some investors are going to take a giant bottle of champagne and pour all the contents into one of these companies in the top layer. Of course, the champagne represents money in this analogy. So, a few of the companies in the top layer receive enormous amounts of funding every given year. And the vast majority of investors spend their entire time in that top layer, trying to predict which company next year is going to receive all that money, all that funding from investors. But trying to pick winners is extremely difficult. All of these companies are competing with each other for funds, for investor funds, also for market share. It's all very exciting, but everyone is looking for the same thing. Apart from being extremely difficult to make any money due to competition, there's another big problem with spending most of your time in that top layer of the inverted pyramid. That problem is that most of the glasses at the top are broken. As soon as a large amount of money flows into one of those top glasses, it ends up flowing downwards to the bottom layers of the pyramid. You can pour and pour and pour champagne all day into one of those top layers, but the champagne is just going to flow downwards because those companies are not made to make money. They are made to grow revenues as fast as possible. And the way you do that is by buying more technology and spending more on capital expenditures. Even companies like Meta, Google, and Amazon. These are huge glasses of champagne. They can hold a lot of money inside. Basically, what that means is that they're very profitable. But even with those companies, most of the money ends up flowing downwards because they're spending on technology, on semiconductors in order to build out their own business. So, whatever disruption ends up appearing at the top layer of that pyramid, it will be using the stacks below it, which are the hardware, the semiconductors, the manufacturers, and finally, the instruments to make the semiconductors. So, it makes everything quite simple, doesn't it? All you have to do is stand at the bottom of the pyramid, invest in one of the four companies that manufacture the equipment to make everything possible, and wait for the champagne to trickle down to you. In general, the closer you are to the bottom of this pyramid, the less competitors you will have. And the closer to the top you get, the more chaotic and unpredictable everything becomes. So, all of this is just some food for thought. Personally, I've been looking at the four companies at the bottom of this inverted pyramid. I've written some extensive research reports covering the company's moats, profitability metrics, and risk profiles on Rated A. Everything is available on the platform. That's it for this video, and I'll see you in the next one.